Hey everyone, this is Dimitri Pergamonic with MarketChameleon.com. In this video, we're going to talk about trading an earnings move using options. When a company reports earnings, we know that the stock could either move up or down. As options traders, what concerns us is the magnitude of the move, or how much can a stock move up, or how much can a stock move down. But what really is important to us is the magnitude or the distance of the move. In order to trade the earnings move, first we want to compile some data. So the first thing we want to know is what is the historical earnings move. This we're going to use as a benchmark to trade around and to help us calculate our historical odds. And for this, we're going to use our historical data. The next thing we want to know is what is the market's expected move? What are the option prices anticipating the move? So we could compare that to the historical benchmark to see how far away is the next expected move versus the historical benchmark. And for this, we're going to use the option prices. Let's use Apple stock as an example. Over here, we see the historical earnings data for Apple. So here we see the earnings dates and then the stock reaction to those earnings. And if we wanted to create a benchmark, we could go back in time, convert the negative moves to positive moves, because remember, we're interested in the magnitude of the move. We convert them all to positive moves and take an average of that to get the average earnings move. We could also look at the highest move, the lowest move, and also the opening gaps. But what I like to do is go to the summary table here of Apple. And here it shows the last 12 quarters. And here are the earnings move for the last 12 quarters, just like we just saw. And here at the table below, these are the absolute moves here. So we could see that on average, the absolute move has been plus or minus 3.9%. The max move was 6.8%. We could find it here in the data table. And the minimum move, the lowest move, was 0.3%. We could also look at the opening gaps. How much did the stock move right at the open immediately following the earnings release? So that's the average move for the opening gap, the high and the low move. We also could see what is the move from the opening to the high of the day, and from the opening to the low of the day, and also the drift from the opening to the close. So this will give us a range of different moves from close to close and even intraday to use in our analysis when we want to create a historical benchmark for earnings moves. To find out the expected move, we're going to use the option prices that cover the earnings release. And over here, this is an options chain. This is the at the money strike price. Remember, we're looking at the expected move. It doesn't matter in either direction, so we're going to use the straddle. So here, I'm going to click on buying the call. That's a bet that the stock's going to increase. And then on the same strike, I'm going to buy the put. And that's a bet that the stock's going to decrease. And let's just take a look what that looks like as a payout diagram. So you could see here that the stock has to move by expiration for the entire cost of both the call and the put to the upside before you start making money, and the same thing to the downside before you make money. And these break-even points, that's where the expected move is, where it exactly covers the cost of the straddle, both the call and the put, for either the buyer or the seller. Let's recap how to figure out the expected earnings move. First, we're going to find the option straddle that is the nearest expiration and that covers the earnings. Then we're going to look at the stock price to find out the money straddle. Let's assume that the call is $3 for the 100 strike. Let's assume that the put is also $3 for the 100 strike. So in total, we're paying $6 for that straddle. And if we sell it, we're receiving $6 for that straddle. So what is the expected move? We take $6 divided by the $100 stock price, and the expected move is up or down 6%. Here's a historical chart of the implied move versus the actual move, which gives you a visual going back in history. So these bars over here, that represents the implied move, either up or down in either direction. That's what the implied move was, versus this green bar, which was the actual move. So you could see here the implied move was 4.7% in either direction. That actual move was 2.1%. And when it's red, that's the actual move to the downside. Here, the implied move was 5% in either direction. The actual move was negative 6.6%. And this is in Apple history in Apple in the last 13 quarters. And over here, we see a summary that the options market overestimated Apple's earnings moves 54% of the time. In other words, 54% of the time in this data set, Apple option prices overestimated the actual move. The actual move was less. And on average, the implied moves were plus or minus 4.5% versus the average of the actual moves of 4.1%. So you could see some traders will try to play the long-term averages. And in this case, they may want to sell the straddles, trying to capture the difference between the implied move and the realized move. So trying to capture that difference, 0.4%. And we could actually compare here. Here's the historicals, how the different option strategies that play the earnings move perform. So here we could see here the long straddle, which is buying the straddle, was 50% win rate. Half the time it made money, half the time they lost. But on average, from the long side, on average, you lost 7% in the last 12 quarters. This is the long strangle. That's a 33% win rate versus negative 32% average return. Here's the credit iron butterfly, credit iron condor. So the reverse of these would have been profitable. And now you could just kind of compare how the option strategies did historically and how did the average actual move compare to the implied move over a longer period of observations. After people learned how to trade the earnings move, what are the most common questions? The first question is, what option strategy worked best? Should I stick with the straddle, the strangle, or what option strategies tended to outperform? The next question we get is, well, what is the best entry and exit points? Should you put on the strategy the day before earnings and take it off at the day after earnings, or should you start 2 days, 3 days, 1 week before, and should you exit before the earnings move? The next question we get is how to get alerted to opportunities. You can do all this analysis by hand, of course, but what we think is a better way to do it is allow the machines and servers crunch all the data and the information and present the opportunities to you. This way, you could streamline the entire process, saving you time, and then you could focus exactly on the best historical opportunities at the present. Here, you could find today's most recent earnings trade opportunities. So in this table, you could see here is a list of symbols and the next earnings release date. And here you see the historical earnings strategies. So this one is the strategy. This is the historical open rate before earnings, 2 weeks before, close 1 day after earnings. This is the historical win rate and average return for the last 12 quarters. And if you wanted to mimic that strategy, this tells you the next open date and the next close date of the strategy. This is the expiration. If you hover over, it tells you the legs. And this is the theoretical value and theoretical edge. So if you wanted to go and look at that strategy, you just simply click on this options expiration. It will take you to the options chain. Then it will line up the legs of that strategy that you just saw. So over here, April 17 put, buy at April 1780 put. You buy it for 201, sell April 1783 put, 245. You load that strategy. this is what the payout diagram looks like at expiration. And if you wanted to see, overlay it with the historical moves, you could just do this, the last 12 moves, and you could see here, these are where the percentage moves were in the last 12 quarters. So you see it covers all this in a green, and that's why this was presented as an opportunity. Hopefully this was helpful. See you guys in the next video.